Hello, welcome everybody. Welcome to this week's webinar. Happy Saturday. I hope you guys all had a fantastic week, had a good trading week. Today's webinar is going to be a good one. I know I probably sound repetitive, but this one's actually really good. So this one's going to be on pivots and ranges, and basically just pivot points and how we could trade ranges and trade these pivots. I'm just going to give it another minute or so to let people join in. But I will give you guys some facts about, ranges and trends. So just so you guys know, the market ranges over 70% of the time and only trends 20 to 30%. So with that being said, it's good to know how to trade these ranges because they do give us good opportunities to scalp or to buy at the lows and sell at the highs. Hey, welcome everybody, welcome. This is going to be a good one. Again, I'm going to give it another minute or so, and then we'll get started. Let me just let everybody in the Discord know. Everyone in our community. Wonderful. Get a few more people in here. Hello, everyone. Hey, John, what's going on? Hello. Awesome, cool beans. We're getting the ball rolling now. Okay. Alright, we're going to be going over pivot points and range trading. So the first category we're going to cover, I'm going to give it another minute. I like to start around 6:02 to give everybody just a couple minutes to join in case they can't join on 6 on the dot. But again, guys, this is going to be a really good one because the market tends to range more than it trends. So once we're able to establish and understand how to trade these ranges, it really gives us the upper hand with the market. So I am going to get it started, and the first section we're going to cover is pivots and pivot points. So what is a pivot point? A pivot point is a key price level used in technical analysis to identify potential support and resistance areas in the market. A pivot point is also used to determine the overall trend of the market over different time frames, and we could see that with higher highs or lower lows, which we will cover later in this as well. They serve as a reference point to determine potential turning points and levels of buying or selling pressure. So guys, as we see right here, we have our pivot at 44.9275. We created a lower high. We created a new pivot there, and we went lower. Now, just so you guys know, this is actually a study. These are pre-plotted swing highs and swing lows, and the link for that is right here. So you enter that into your Thinkorswim, and you'll have this study as well, and you'll be able to play with it as you please. So that's a really good one. So next, we're going to go how to use pivot points to identify support and resistance levels. So pivot points can be used to identify support and resistance levels because they are often areas where the price of an asset tends to reverse direction. Now remember guys, if it's a pivot point, we're looking for pivots. A pivot is a sharp move. So we have resistance at this top one. The pivot high would be the resistance. The pivot below would be support. So this resistance gave us a sell-off and another pullback, and this support held up as well. This was even considered a liquidity grab, which might be the bonus content later. So make sure you guys stick around. So let's see. So pivot points, right, can be used to identify support and resistance. It suggests that buyers are stepping in after a downtrend, potentially indicating an upcoming upward reversal. That's when we break these supports or resistance. When the price is above the pivot point may act as a support level, right? So this is a pivot point, this is a pivot point, and they were acting as support. Now this is a pivot point, this is acting as resistance. Alright, so let's go into the next one. And each slide, guys, the pictures are real-time ES. So these are real examples of trades that we could take going forward to look for in the market. And guys, just so you know, you could chart these pivots and the range trading on any time frame. Ranges and pivots are on any and every time frame. 1 minute, 5 minute, 4 hour, daily, weekly. Every candlestick chart can be seen and used with pivots, higher highs, lower lows, and ranges. So pivots can assist in determining appropriate levels for setting stop losses and take profit orders. Traders may place stop loss orders below the nearest support level or above the nearest resistance level, right? So we know a swing high we might not hold, or we know a swing low we might not hold. So let's say we wanted to enter based off of this strong move higher. We could enter on the break right here, and we could have our predetermined stop loss right here. So we know what we're risking, and we could have our target somewhere near another relative high. Take profit orders can be set near the next significant support or resistance level as well, just like I said, but it's important to understand that a lot of traders are watching these pivots, and this can often lead to liquidity grabs. Again, I know I mentioned that earlier. That's going to be the bonus content if you guys stick around towards the end. Oh, just so you guys know, so let's say, right, so you enter there, you have your stop loss there. So it gives you areas to enter, areas to exit. And here's a great example of trading a range and how we would take it. So how to use pivot points in range trading strategies. Pivot points are valuable tools in range trading strategies, helping to identify potential reversals and trading opportunities within a defined range. Buying near the support levels and selling near the resistance levels can be part of a range trading approach using pivot points. Again, guys, this is a great help. There's a pivot right here. It didn't plot for some reason because it was an indicator, but this pivot, we failed it because this was also the top of the range. And what we would do is we would enter on the rejection of the top of the range. So we would enter short around here on this rejection, and we would have our take profit at the bottom of the range. So we would enter and we would have our stop loss right at the top. So once we failed to break higher, creating a lower pivot, a lower high, we know we could enter this and this is valid. We take this trade, it chops around a bit, but eventually it hits our take profit, and that's what we wait for, guys. Now, when you enter a trade, you have to remember everything in between your entry and your take profit is all noise. Just because you enter here and it comes down over here and it starts to pull back doesn't mean you should exit. There's either your take profit or your stop loss. The market knows how to wiggle us out of trades. So additionally, us traders can monitor pivot point breakouts above the resistance level or below the support level for potential trend continuation signals, which I'll show you a good example of that in one of the upcoming slides. So basically, a summary of pivot points. Pivot points are a powerful technical analysis tool used to indicate potential support and resistance levels. They help traders gauge market sentiment and anticipate price reversals and identify key levels of buying or selling pressure. Guys, pivot points are huge, especially when you're using them along with knowing how to read higher highs, lower lows, and higher lows, which we'll be going over in just a moment. So traders can also use these pivot points to set stop losses and take profit orders, identify support and resistance levels, and to implement range trading strategies. And that's going to be our next section. First, I want to cover higher highs and lower highs. Now, this is something you'll often hear me mention on the live streams or in most videos, because being able to read higher highs and lower lows and higher lows, that really gives you the ability to read the direction of the market a lot more clearer. So higher highs occur when the latest peak in price action is higher than the previous peak. It signifies upward momentum and potentially indicates an uptrend, right? So here we have a higher high, another higher high, and another higher high, and we've been trending upwards this whole time. Whereas a lower high happens when the latest peak in price action is lower than the previous peak. It suggests a downward pressure and potentially indicates a downtrend. So you see we started to reverse. We pull back, we create a lower high, and a lower high, and each time we pull it up a bit to create this lower high, it gave us another opportunity to go short. Now let's say we wanted to short around here, we'd be able to place our stop loss at the previous lower high and take profit at another area of support. Lower lows and higher lows. So just like higher highs and lower highs, this is now on the opposite side. Lower lows occur when the latest peak in price action is lower than the previous peak. So that would be, see this low right here, and we created a lower low right here. It suggests downward momentum and potentially indicates a downtrend. So if you see continuous lower lows and you also see lower highs, that's a good combination to know that we're trending downwards. Whereas higher lows higher lows happen when the latest peak in price action is higher than the previous peak. It signifies upward pressure and potentially indicates an uptrend. So again, guys, if we're looking for higher lows, right, that means the market can't break lows anymore. We'll keep pushing higher. That's bullish sentiment. What we would also look for is for the market to create higher highs with higher lows. Whereas on downtrends, we look for lower lows and lower highs. And that's a great way to understand pivots and get into that. So traders analyze these patterns to determine the strength of trend and anticipate potential trend reversals or continuation. So you see the market sort of got tight right here because we created higher lows, but we also created lower highs. So price got tight, almost like a triangle pattern, went up, down, and we kept chopping until we got a big pop to the upside. So that was it for our pivot section. Next, we're going to cover range trading and how we could trade the ranges and use ranges to our advantage. Because a lot of times, guys, as I mentioned before I started, the market tends to range 70 to 80% of the time and only trends 20 to 30%. Now, that's a lot of ranging. So if we could learn how to use range trading to our advantage, it's really great. So what are trading ranges? Trading ranges are price consolidation phases where the price accumulates within a defined range. They occur when neither the buyers nor the sellers have enough momentum to push price either direction. So as you see here, we're very choppy. As you guys, I'm sure, hear often as well, there's ranges and then there's choppy markets. This right here looks very choppy. Some people even call it barcode, right? Like we have a barcode because, you know, you scan a barcode, it's black, white, black, white, black, white. This is green, red, green, red, green, red. It's very choppy price action. This is not a clean range to trade. Whereas if we look over at this range, it gives us some nice, simple sell at the highs, buy at the lows, and then we had a breakout. We even came back and tried to have a retest before continuing. So in these types of channels and in these types of ranges, we want to be buying at the low and selling at the high, unless we're failing to sell off at the highs, right? And I'm going to cover that in another slide or two. They occur, ranges can be characterized by relatively horizontal price action with well-defined support and resistance levels. So this range right here is not the strongest range. Why? Because we don't come up as cleanly as we should. Just like this right here, we broke out of it, came back in, we retested it, but then we got no more short entries at the top of this range. We did, however, get some long entries, but this is not that valid of a range, and I wanted to point that out to you guys. We need to see a clean range with I don't want to say with no breakouts, because every once in a while you will get a small breakout here and there, and those again could be liquidity grabs, but we want a clean range to trade. Range trading is phenomenal, guys. You might think, oh, well, it's range trading, I'd rather be in a trend. But when we trade a range, that gives us our entries and exits perfectly. It gives us the lows to buy, the highs to buy. How great is that for the market to tell us, buy down here, sell up here, because it's in a range? So, they represent a period of market indecision and can last for various durations, from short-term intraday ranges, like on the 5-minute or the 1-minute, to even long-term ranges spanning days, weeks, or even months. It all depends on the market sentiment and the market context that we're in. Don't forget, guys, I do appreciate it if you hit that like button. I will keep going through this, but do appreciate that. So how to identify and define a trading range on a price chart. To identify a trading range, look for relatively flat price action with multiple touches at similar price levels. So here we have touch 1, 2, 3, and then this is even 4. And then down here we have 1 and 2. So obviously we're getting more touches near the top. We're drawing liquidity from this top channel looking to break it higher. A valid trading range requires at least 2 touches on each support and resistance. So again, 1, 2, and then this one's 1, 2, 3, almost 4. The more touches at these levels, the stronger the range is. So if we're in this range and we're going 1, 2, 3, 4, 5, and we're staying in this range, then you have no reason to try to trade the breakout. That just gives you the confirmation that we are in the range, and you should continue trading that range. So in a range trading, the candlestick spread should be smaller than the range. Yeah, so that's a good question, but yeah, you're not really going to get a candle that's the whole entire range, because the range tends to be multiple candles creating this range. You can either use the trend line tool to mark the zones or the channel tool. I like to use the channel tool on Thinkorswim because it creates very straight and very connected levels, and so I could really see it. So I don't have to be worrying about up top, down low. I just here to here, go down. It's already mapped out for me. I just got to click it to whichever candle I'm looking for. What are the key characteristics of a trading range? So range-bound price action often exhibits low volatility and relatively equal buying and selling pressure, hence the range. Buyers can't push us higher, sellers can't push us lower. Price tends to range between support and resistance levels, creating predictable price boundaries. Imagine that, guys. The market being predictable. If that's not a blue moon, I don't know what is. But with ranges, we're able to find these support and resistance levels and trade them accordingly. And it really is almost predictable. So breakouts from the range can lead to significant price movements, providing trade opportunities as well. So we have to think, if we're stuck in a range, eventually one side's going to win. Buyers are going to win or sellers are going to win. And when they do, they're going to run because we just consolidated and grabbed a whole lot of liquidity before pushing higher or pushing lower. Volume tends to be lower during a range, and we have to remember that because that reflects reduced market participation. And when we have reduced market participation, there's a good chance the bigger firms, prop traders, big traders are not trading a range, especially if it's on a smaller time frame, a 1 minute, maybe even a 5 minute. They might not even like that. Me personally, if you find a range on any time frame, you trade that range on said time frame. If you have a daily range, right, let's say this was a daily, you would buy low over here and you would swing trade until it comes back to the top of the range. Same thing if you would short it up here and target the bottom of the range. If you short it up here, though, you can't put your stop at the support level, at the resistance level. You would have to put the stop at the previous swing high. Because remember, now we're making a lower high as well. And that's something we learned in our previous slides. So, let's see. Breakouts, lower volume, lower... Yes, perfect. So how to determine support and resistance levels within a trading range. So I'm just going to go over some basics of what support and resistance are in case you guys haven't seen the previous webinar on support and resistance. So support levels are price levels where buying pressure is expected to overweigh selling pressure, causing the price to bounce higher, right? So this would be our price range. This would be the support level where buyers are stronger than sellers. Buyers again stronger than sellers, again stronger than sellers. Look at all the opportunities to buy at this price level that the market gave us. That would have been fantastic. Now when you enter and when you trade these ranges, you don't have to enter, it's definitely good to enter at the bottom or at the top, but you don't always have to target the next top or bottom. Sometimes, right, like we might fail it right here, then we created a lower high before coming back to the bottom of it. So if we wanted, once we recognized the lower high, we could scale out of our position because we already entered way down here, and we could take our profits. Sometimes people even put a median line right in the middle, and they'll buy at the lows, sell at the middle, wait for it to come back to the top or the bottom, enter again, and again sell at the middle. Hey, welcome Nick, welcome everybody. Appreciate you all for tuning in today. This is going to be a good webinar. I think we're already a bit over halfway over. So this is, again guys, this is a really good one because sorry. When I go off script, I can't think straight, can't talk right. No, but this is a good one because again, price ranges very, very often. 70 to 80% of the time, price is stuck in a range versus the 20 to 30% that we are trending. So once we're able to establish and understand how ranges work, we could use it to our advantage to understand where to sell high and where to buy low. So resistance levels are price levels where the selling pressure is expected to outweigh buying pressure, causing the price to reverse lower. So again, this is a resistance level. When we use channels and ranges, the top of the range is resistance. The bottom of the range is support. It's supporting the stock. It's holding it up. This is resisting the stock. The stock's resisting this level. So identify support and resistance levels by observing previous swing lows and highs respectively within the range. So you see how we sort of started to wick, again a swing low, then we did break it, retested, and we went higher. So just so you know, the more times the price tests and respects these levels, the stronger they become. But on the other hand, we have to remember the weaker the rejection from these levels, the weaker the level gets. So we sold off from this level 1, 2, 3, 4 times. But here on the 4th time, we go to sell off, but instead we reverse and come back higher. Now the reason for that is each time we rejected this area of liquidity, we're drawing more liquidity from that zone, making that level weaker and easier to break through. So what happens, we failed the sell-off and we pushed back higher. We would have been able to enter on the break, put our stop loss at this candle's low, and let that trend play out. What are common trading strategies used within range-bound markets? So here's where it gets fun, guys. Like we weren't having fun before. Range trading strategies involve buying near support and selling near resistance, as I've been saying. Traders may use oscillators such as the Relative Strength Index, which you might know as the RSI, or the Stochastic Oscillator to identify overbought and oversold conditions within the range. So as you see here, guys, ES is in a range, right? But ES is creating equal high, equal high, equal high, but RSI is showing divergence. RSI created a lower high. That would signify that the market is getting weaker. So we would be able to enter once we saw this divergence, enter short positions somewhere up here or even on this big candle going lower, put our stop loss at the top of the channel and be able to ride it to the next pivot low, which would be right here, and our target would have been met. This would have been another fantastic trade. Breakout strategies aim to capitalize on price movements when the price breaks out of the range boundaries. Again, guys, once we're in this range and once we break, we tend to get a bit of a trend. So we might range, let's say, again, I mentioned the 70% to 30%. Say this range 70%, and then this 30% drop was our trend. That 30% is going to look very strong. Does RSI work well on the 5-minute? Yeah, it does. It does for sure. I believe this even was the 5-minute chart when I took a picture of this. Do you use any indicators including RSI to help identify support and resistance? No, so I would use RSI just to measure overbought or oversold areas, or again looking for some type of divergence that would suggest that we're going to reverse. So what I would do is I mainly use just price action. Nick, I'm not sure if you're part of our community or not. This is the first time I'm seeing you comment in here. But I mainly do price action, so just price action trading along with supply, demand, and support and resistance. So I tried not to keep any indicators on except maybe VWAP because that's the volume weighted average price and that's measured by volume. So what I would do with RSI is I would look at this price action. I would see we're rejecting this high one more time. This would even qualify as a triple top, which you guys could check that out in the recent webinar on charting patterns. And that's 1 top, 2, 3, triple top in a channel, big sell-off, big push lower. That would have been a fantastic trend trade. How to identify potential breakout opportunities from a trading range. Yeah, no, I got you, man. No problem. Absolutely. Guys, don't forget to hit that like button. I do appreciate it. Hit like and subscribe. We go live on YouTube Monday, Wednesday, Friday for free for you guys. And for our members, we go Monday through Friday. So how to identify potential breakout opportunities from a trading range. Look for signs of increasing volatility, such as expanding range or rising volume, indicating potential breakouts. Breakouts can occur in either direction, so make sure to monitor the price's ability to sustainably move beyond the price's boundaries. So if we're looking at this range right here, this breakout is not valid. It was not strong. This little wick right here, not a breakout, not valid, not strong. Became a member, he's even better on the... Thank you, Victoria, I appreciate that. Alright, so basically how we would trade this one before I get back to over here is we would enter with strength on the breakout below, and we would put our stop at the previous lower high, and we would be able to take profit and target our previous swing lows. So take profit 1 would be right here, and take profit 2 would be right here. This would be another trade that has a very small risk and a very large reward. We hit both take profits very quickly. We often don't see a move that goes directly to our target, but this would have been a phenomenal trade. So you could use the technical indicators such as moving averages or Bollinger Bands to identify potential breakout points. And that's really helpful too. So I know Bullish Bears Jeremy is a big fan of using Bollinger Bands. I don't use them too often, but they are great in a sense of they would get tight over here. And when you have Bollinger Bands, it's called a Bollinger Band squeeze. What that means is the market is getting very tight and it's getting a lot of pressure. Whether it's buying pressure or selling pressure, we don't know until we start getting that breakout trend. Cool. So consider confirming breakout signals with additional price action confirmations or other technical analysis tools. Another way you could have entered this, unfortunately, this trade didn't give us a pullback and a retest, and a lot of times members in the community know that I wait for that retest before we go lower. This was just too strong, it just sold off like crazy. So this would have been, again, enter with the strength, stop loss at previous highs, let the trade play out and hit our targets. Summary of range trading. Can you please explain the Bollinger Band squeeze? Yeah, I'll go over that. No, I might not cover the Bollinger Band squeeze in this webinar just because it's not too correlated with it. If you guys do want, though, eventually I'll cover I'll do an indicator webinar, and I'll cover like moving averages, how to use them, maybe like an 8 EMA and the 20 EMA, because that's a good strategy people use, which is similar to the 9 and the 21. Only difference is when you go lower in the numbers, it's tighter to the candle, so it gives you more reactions and more buy-sell signals. So let's see. So trading ranges are periods of price consolidation where the price accumulates within a defined range. This is just the summary of range trading, and then we're going to go over that bonus content for you guys. And yeah, no problem. It's my pleasure. We'll go over, when I go over the indicator webinar, we'll do moving averages, Bollinger Bands, RSI, stochastic, anything you guys could think of. So let's see. They occur when the market participants lack the momentum to establish a clear trend, resulting in relatively horizontal price action, right? So if we're in a range, it's going to look choppy. It's going to look sideways. It will not look like a regular trend. Trading ranges are characterized by well-defined support and resistance levels, offering trading opportunities within the range boundaries. So this right here wouldn't be too strong of a range because there's no exact support level, resistance level up here, and same with support. So what we would do on this would be more of a choppy market. We would notice that we're creating higher lows, and higher highs, higher highs, higher highs. Now, what we would look for is we'd look for increased volume to break the range as we got, this is the 15-minute candles, so this was a big breakout. It broke out, pushed higher. We again consolidated, and then look at the volume increase on this candle. Now, that was a good breakout candle right there. So range trading strategies involve buying near support and selling near resistance, while breakout strategies aim to capitalize on price movements beyond the range boundary. So again, when we take breakouts, we can't just take it just because it's breaking out, because it could very well be a liquidity grab or a fake out before we get the actual move. So let's see. So now we're going to move on to the bonus content, which is liquidity grabs. Now, guys, liquidity grabs are a fantastic trading tool and a really good trading strategy to add to your playbook of trading, because liquidity grabs are often used well. Now, let me explain. Liquidity grabs are price movements that occur when market participants exploit liquidity imbalances. This is basically to trigger stop loss orders or trap traders on the wrong side of the market. They often involve rapid price spikes or drops, creating temporary disruptions in the market. So as we see here, guys, we have this triple bottom, right? We have our support, we have our swing low, and what happens? We wicked it. Now, at this point, this candle wasn't a wick. This was a full body candle breaking the lows. And retail traders or people who aren't aware of liquidity grabs might see this as, oh, well, we're going lower, we broke previous lows, let me short here. Or if they went long over here, they would have their stop losses here. The market came down, stopped them out, and then reversed in their direction. Now, how often does that happen where you get in a trade, price stops you out, and then it goes in your direction? Once you understand liquidity grabs and how the market moves, you're able to then be patient and wait and say, okay, well, if I were to enter here and put my stop here, they might stop me out here. So instead, what I'm going to do is I'm going to be patient, wait for some sort of liquidity grab, and enter once it starts wicking back up. Then once you're able to enter here, you're able to ride that trend, knowing that all these people down here who were trapped or who stopped out are putting fuel in the fire to push us higher. So liquidity grabs can be initiated by institutional traders, large market players, or algorithmic trading systems, not retail traders. We don't have the power or money to make that happen. You hate, yeah, I know, Wolfie, right? Isn't it the worst when the market's like, oh, nope, we're going to reverse, stop you out, and then go higher? Whereas if we were just a little bit more patient, we would have not only been able to get a better entry, but we wouldn't have been stopped out. We would have been in a phenomenal trade. So traders should be aware of liquidity grabs and take precautions to protect their positions and manage risk. So again, guys, if we're entering somewhere over here, it's hard to put our stop loss right here, knowing that the market may pull back into what's called a liquidity grab. Instead, let's use that to our advantage, wait for some sort of liquidity grab to form, and we could even wait for the candle to close if we want to make sure that that is what's going on. And then we could enter right when this candle breaks this candle's open, because this is the candle that created the liquidity grab. You put your stop at the lows, and you would let it run. So traders can enter liquidity grabs by identifying conditions that may lead to such movements, such as low liquidity, consolidation patterns, or news events. So we want to be aware of what's going on in the world as well as the market. Are we in a choppy range? Have we been failing to hold lower? Have we been failing to hold higher? What are the higher highs doing? What are the lower highs doing? What are the lower lows doing? And that's really, really great stuff to know and be aware of. This whole webinar, guys, if you just learned and understood this, you'd probably be able to trade the market a bit more successful than you have in the past. So by monitoring order book depth, volume profiles, or price action, traders may spot potential liquidity grab opportunities. Oh no, the video stopped? No, don't say that. Does this apply to Forex or stocks or just candlesticks? That's a good question. Basically, It basically applies for any market, right? So any market with high liquidity could even happen on things like Apple, Microsoft, Amazon. Me personally, I like to look for it on ES and NQ because that's the S&P 500 and the NASDAQ. And these are very, very high and very liquid stocks that often have these liquidity grabs because the market knows where retail is putting their stops. But it's crucial to exercise caution and have proper risk management in place when participating in liquidity grabs, as they could be highly volatile and short-lived. So again, guys, we could have a liquidity grab down here, stop these people out, go higher, and we have to think, what are they thinking now? They're thinking, well, I should chase this higher, but what if we ended up reversing once we wicked the highs again? Now they're in another wrong trade, and we don't want that. We never want a revenge trade. We never want to overtrade. We want to take our time, be patient, and let the market come to us. All right, so I believe that's it. Thank you guys for watching. I do appreciate you all for tuning in. Don't forget, hit that like button before you guys go. We do this every Saturday. Next Saturday, I'm not too sure on the topic yet. One of our members did give me an idea to do it on, maybe indicators or something. Maybe we'll cover some moving averages. Maybe we'll cover Bollinger Bands, RSI, things like that. I'm glad I was able to get this one done, though, because pivots and range trading is very, very important because it also teaches you how to read higher highs, lower lows, and gives you really good, clear definition on market sentiment. What's your Discord link? Nick Vaughn, just so you know, we don't have a link to the Discord, but if you go to bullishbears.com, that's where you could sign up to become a member. Awesome. Yeah, I appreciate you guys. I'm gonna go back to one of the slides, probably one of the first slides, to give you guys that indicator one more time. Let's see. There we go. So in case you guys were curious and did want that indicator, right down here is a study. So you're going to copy this, and you're going to go to your Thinkorswim, and you're going to open that up. And again, that will plot pivots, pivot highs, pivot lows, and that's really good because if you are new and you are trying to understand higher highs and lower highs, understanding pivots is the first step, and this indicator is almost like a training wheel. And you know what? Even a pro would use it because look at how well it could work out, right? It gives you the ranges. So yeah, bullishbears.com, and when you sign up, you get access to our website, which is full of a bunch of courses, next level stuff, beginner stuff, really great stuff, and it also gives you access to our Discord community, where we go live every morning from market open till about 11:30, and it's really great. Where can I find previous videos? So if you go to the Bullish Bears, our YouTube page, go under playlists. It's going to be under webinars. This is webinar number 6, so we got a few to go through. But I would suggest starting with this one. We have an options basics webinar, supply demand, support resistance, whole bunch of them, whole bunch of good ones. All right, guys, you guys got any questions before I sign off? I know this was a bit of a shorter webinar this week, but that's all right. Not everyone's going to be an hour and a half. Love options. You use Wicks with the resistance support levels? Nick, that's a good question. So yeah, when you're trading and when you're making these zones and ranges, you're going to want to be aware of the Wicks. Because if the Wicks are holding, you're going to want to mark those as the range. But you also don't want to get faked out on every time we go lower. Because when we wick above a range, it doesn't mean we're breaking out. It just means it could be a fake out. It could be a liquidity grab. It could be anything but a breakout. And if we're trading it as if it's a breakout and it doesn't work, let's say this was a big green candle at some point, right? And we thought, oh, well, this is clearly going to break out here. And we chased long positions. Well, we should have been more aware that we were in a channel, because now you're going long or buying calls up here, and it's going to wick down and go all the way down, where you would rather go short here and play the channel, right? We always want to remember, trend is our friend, the channel is our friend. Any clues the market gives us, any repetitiveness, again, guys, channels become predictable. They give you the lows, they give you the highs. Same with pivot points. You ever trade on algorithm Let's make it automated. No, I haven't, but that does sound cool. That does sound cool, Frank. I appreciate you pointing that out. When the range is ending, the reversal becomes weaker. Are there any other clues? It's about to end. Yeah, so what I look for on these ranges, let's see. So let's look at this range. Don't look at this range because, again, remember, guys, this is not that valid of a range because we failed to get back up to these highs frequently, and we only really held the support once, two times, not too strong. But this one was a clearer trend, a clearer channel. Now what we'll see is when we start to break it is we'll come back from the lows, we'll come higher, we'll go to sell off, but we'll fail the sell off. And once we fail that sell off, the longer we hang out near this key level, the weaker it becomes, because the longer we're near it and the more touches we have on it, the more we're drawing liquidity from it. So the weaker that level gets. Another good example of that would be this one right here. This one, right? We had a wick above, which would have been the liquidity grab from these wicks. We went lower. We failed to go to the bottom of the channel. We reversed back up to the top, failing to sell off again. Once you see that we're failing to sell off, expect some sort of move or breakout. Yes, absolutely. Absolutely. Again, any other questions, guys? Drop them down in the comments now. I'm just going to go over these images one more time for you, and then I'm going to wrap it up. So again, you would sell high, buy low, and it's really great because it creates predictable price boundaries. And the market, 9 times out of 10, is not predictable for us. But when we get into the math of it and know that, well, the market ranges more than it trends, well, then maybe it is more predictable than we think. Maybe we are overcomplicating it a little bit. And that's when we got to take a step back and figure it out. Now, it's another good example right here. So see how we broke out right here? This would be tough, right? You would put your entry, when you get a dip below res or peak above, are there any visuals which identify a reversal? I get caught. Yeah, so Nick, that's a great question. I was actually right about to go over that. Yeah, you're going to want to be super careful when you're trading breakouts too, because you got to remember there's a reason you have this key level here. There's a reason you have this channel up here, right? So we had this breakout and then we just failed. So what I would have noticed was that we came up to here and we didn't have any type of rejection at all. Now, usually when we come up to a key level or a support or a resistance, we usually get some type of chop right before it and then a push lower, or some type of chop, a wick, and then a push lower. Whereas this move just came right straight up, it pushed through, but because this is an area of interest, you guys hear me say that often too, an AOI, area of interest, or a resistance level, we know that there are more selling participants than buyers. So we would wait for the confirmation. This would end up pulling back. And again, what I look for mainly on the breaks of these channels is I look for us to fail the sell-off before we rally higher. Because once we fail that sell-off, I'm able to enter on the push higher and put my stop at the lows. So I could have a really small risk and try to ride that trend break. Same with when we go lower. If we were going lower over here and instead of going higher, we started push higher and then we rejected and came right back down, I would look for these candles to break and close below. But because we did end up holding, came back down, and then look, this is a liquidity grab because it wicked the lower low. It wicked, now it's making a lower low, but then it did that so it could grab liquidity to push us higher. Yes, absolutely, John. I hope you guys all appreciated and learned something from this webinar. This was a really good one. I've been putting it together for a few days now. And yeah, if you guys got any questions before you head out, definitely drop it in the comments. Again, we do this live every day, Monday through Friday for our members, and Monday, Wednesday, Friday on our YouTube for everybody. Awesome. Glad you enjoyed it, Victoria, and everybody else. Nick, I'm glad you joined. I don't think I've seen you in here before. Happy to have new faces. Really appreciate that. And again, guys, you guys got any questions? If you're a member, you could always shoot me a message on Discord. You could direct message me or hit the questions tab. or anything you guys need, you could always reach out. We got a big community, and we have a lot of teachers and educators in there as well. All right, I hope this helped, and I hope you guys all have a great night and a great weekend. Happy trading.